In today's video, we will look at 5 of the highest quality dividend-paying companies available. These are all excellent companies with substantial moats. They have strong management teams, solid balance sheets, and they have withstood the test of time. They are leaders in their industry. These businesses can continue to perform well over the long term, regardless of the economic climate, and help you boost your dividend income for years to come. Let's now look at 5 of the top dividend stocks you can purchase and include in your portfolio. For full disclosure, I do not own any of these stocks at this time. Please do your own research before investing. Number 5. Procter Gamble. Procter Gamble stock, ticker PG, is a high-quality dividend investment that you may hold in your portfolio. A global manufacturer of consumer goods, Procter Gamble has a $355 billion market capitalization. In the majority of American homes, you can discover products from Procter Gamble. Consider goods like soap, toothpaste, toilet paper, laundry detergent, and razors. These are all things that are constantly needed. When investing in dividends, you should have a good mix of dividend growth stocks as well as fallback. Look for those consistent companies that will be able to raise their dividends consistently and perform well regardless of the economic climate. Procter & Gamble does not grow as quickly as it once did because it is now a much more mature company, but it grows at a more consistent rate. Speaking of consistency, Procter & Gamble has raised its dividends 66 times in a row. The current payout is 3.65 cents per share, or 2.46%, and it has done so for 66 years. With a dividend payout ratio of 60, the company has lots of ability to grow going forward. In terms of dividend growth, Procter & Gamble has raised their payout at a rate of 5.6% over the last 5 years. Number 4. Realty Income Corporation. Stock ticker O. Realty Income is a real estate investment trusts, or REITs, own real estate and lease out to tenants. They also benefit from tax advantages that allow them to be more pass-through entities and not be taxed at the corporation level. Realty Income is referred to as the monthly dividend-paying company since they pay a monthly dividend rather than a quarterly dividend, which many dividend-paying stocks do. With over 11,400 properties, Realty Income has a portfolio occupancy percentage of 98.9%. It's noteworthy that the occupancy rate has never dropped below 96%. There are 1,100 different tenants in the portfolio spread across 72 different sectors. They have properties abroad as well. The corporation actually owns close to 200 of them. Realty Income is not just one of the best managed REITs and the benchmark for the REIT industry. It is also one of the very few companies in the S&P 500 and on the list of dividend aristocrats, indicating that it has paid increasing dividends for at least 25 years in a row. Realty Income has paid 625 monthly dividends with 99 consecutive quarters of increases, in addition to 25 years of rising dividend payments. It follows that they are actually boosting their dividend on a quarterly basis in addition to an annual basis. A very robust balance sheet with an A rating supports the business as well. Number 3. Johnson & Johnson. Stock ticker symbol J&J. Johnson & Johnson is a global leader in pharmaceuticals. Johnson & Johnson has a market value of $436.9 billion. It's likely that every household in the world has at least one Johnson & Johnson product. Your headache doesn't care if the economy is flourishing or in a recession. Therefore, you still need Tylenol. No matter the economic climate, bandages will still be required for the scrapes your kids will get. They won't happen more frequently or less frequently in a recession. Due to this, Johnson & Johnson is a business that is essentially recession-proof. It might decline, but not to the extent that this high, ultra-growth stocks would. And it won't rise as quickly as some of those ultra-growth equities when the economy is exploding out of control. Johnson & Johnson continues to offer growing dividends, continuously increasing sales and free cash flow, and consistent dividend growth even though it does not grow as quickly as it previously did. Johnson & Johnson pays out a dividend of 4.52 cents per share, or a yield of 2.72%. Additionally, the company's payout ratio is only 43%, which suggests that there is plenty of room for future growth. The business has grown its dividend for 60 years straight, making it a dividend king rather than just a dividend aristocrat. Imagine 60 years of uninterrupted dividend growth. That is very impressive. Number 2. Microsoft, stock ticker MSFT. Microsoft is one of the biggest and most well-known businesses in the world. In fact, they currently have a market valuation of $1.7 trillion. More than likely, you are using one of its products. Microsoft not only owns the well-known Windows and Microsoft Office platforms, think of Excel, Microsoft Word, and PowerPoint, but they also have a presence in gaming and the cloud. Microsoft is one of the top 3 cloud service providers on the market right now. As a result of the massive migration of businesses and individuals to the cloud. All of this has contributed to the company's ability to boost cash flow, which in turn has allowed it to raise dividends for the past 20 years and counting. Microsoft's revenue over the previous 12 months and going forward has also exceeded a $200 billion run rate. All of this gives Microsoft a significant growth window, especially given the strength of Azure and their cloud offering. Over the previous 5 years, Microsoft has boosted their dividend at a pace of 10% per year going forward, which will in turn feed a growing dividend. That is a very well-run, high-quality company that pays a very secure dividend that is rising at a low payout ratio. Therefore, if you are building a dividend portfolio, consider Microsoft because it has great growth potential for dividend payout. Number 1. Apple, stock ticker AAPL. Apple is currently the largest public corporation and the largest firm in the world with a market cap of $2.2 trillion. Since its start as a consumer hardware company, Apple has been able to innovate and has successfully expanded its business to include a sizable services or software division as well. They provide numerous additional products in addition to the iPhone, MacBook, Apple Watch, AirPods, and many others. They make money through insurance and products, iCloud subscriptions, and other subscriptions. They are even planning to introduce a new subscription model for the iPhone, which means subscriber gets a new iPhone every single year. Apple is not only innovative, but they also have continually produced increasing sales and cash flow, which has resulted in a mountain of cash. Many people think that Apple is not only one of the top corporations, if not the best in the entire world. Although Apple is still a relatively new dividend payer, they are just getting started and will make a fantastic dividend growth company in the years to come. Over the last 5 years, Apple has boosted the dividend at a rate of about 9% per year. Apple's share price has increased faster than its dividend. Keep in mind that a higher stock price corresponds to a lower yield. As they continue to innovate and develop their service revenue, which is a very high margins, Apple is a must-own company for any portfolio. No wonder Warren Buffett loves Apple. His company Berkshire Hathaway has a 5.4% ownership stake of Apple, or 40% of its entire portfolio. Apple will fuel a growing dividend for years to come. We have just looked into 5 distinct dividend-paying companies, some of the highest caliber ones available right now that you could essentially buy and retain for life in your dividend portfolio. These companies are among the best available. They offer dividend growth and, more importantly, dividend consistency. If you learned something valuable, please make sure to like, subscribe, and hit the notification bell for more contents like this. You can check out more videos on the channel and share. See you in the next one.